Hi, this is Michael Carlin, President of Wealth Management here in Scottsdale, Arizona, with another market outlook. This is the third quarter 2017, and just when you thought it couldn't happen, it happened again. We got new market highs. Unbelievable. But the big questions that we're asking, that you need to be asking are, well, great, so what happened? Why did the market go up? What's going to continue to move up? What do we need to look out for? We've got a lot of data. We've got a lot of information to pour over. So without further ado, let's go ahead and dive into the changing face in retail, the impact on our world, and the market outlook for this quarter. So as we start to kind of look through the layers of this onion, the first is, let's understand the returns. What's done well? Amazing first quarter and a good second quarter as well for large and small stocks here in the United States. And if you look, large stocks performed even better. Look at those numbers year to date in the middle. Large stocks up almost 10%. That's what you'd hope to get in a year. You got it the first half of the year. Small stocks up 5% for the first part of the year. It's interesting, though, when you look at those two things first, is that you'd expect small stocks to grow more. Again, small companies tend to, over a long period of time, grow by more than large. And in fact, if you look past the past 100 years, small stocks tend to grow at an average of 12%, where large only 10%. That 2% difference adds up to a whole heck of a lot over a period of time. So when you see underperformance like this, sector versus sector, you start to think maybe there's opportunity and upside. So that's what we're seeing. We think that's something you should look at as well. Then you look at the most startling numbers on this page, and this is, look at that international benchmark. It's the EAFA. And then underneath it, the Emerging Market Index. What a first part of the year. Amazing. The international managers that we use are up about 20% on the year. And if you look, international stocks up about 13.8% and emerging markets up 18.4%. What a great turnaround. What a great turnaround. And if you look again to the 2016 numbers, you can see 2016 international stocks hardly did anything. Emerging markets had a nice bounce back year, but my goodness. What is going on? Well, internationally, there is a lot of thought that a lot of the bad news is behind them. And you look at some of the economic numbers, and they've been quite good. They've been quite good. They've been quite strong. So with that, the market's taken off over there. We still have our issues and challenges here in the United States with our economy, and they certainly have it there overseas as well. So if you captured some of these returns, as we have, maybe this is something that you want to look at and say, do I start to take some profits and maybe put some money elsewhere? Where would you? And if you're looking at the stock part of the portfolio, maybe small starts to look a little bit more attractive. And if you look at the bond numbers, kind of that credit, the government bonds, and that whole area, all the different areas of the market, you've seen year-to-date numbers where they've grown too. So you had stocks going up and bonds going up. Awesome news. Doesn't always happen that way, but that's what's been going on this year. What you had happen is that when Trump won, interest rates went up in anticipation of a whole new economic growth rate that we haven't seen in decades. And what you've started to see as the presidency has had a little bit of a tough time getting some of those objectives through, you're starting to see interest rates start to meander down. And as the interest rates start to meander down, as they have this year, bond prices and bond returns go higher. So we've seen in this from January through to today, bond yields relax and start to move down slowly. And really what we're anticipating is more of the same, which is right now the market and bond market saying, oh gosh, I'm not really sure we're going to see major reform. If you've been paying attention to the past couple market outlooks and what we've been saying, we're really hopeful that we start to see some of those implemented changes. We really love to see corporate tax reform, individual tax reform, some kind of healthcare reform. We want to give certainty to the economy, and we'd love to see things expand positively. But things have kind of stalled out. We'll get more into what that looks like a little bit later. And then you've even seen good numbers from the alternatives. That's the lower piece on the bottom. And all in, it's been a pretty nice first part of the year. And if we kind of, again, look a little bit deeper into what the numbers are telling us, well, let's look at the first 180 days or so again, we're going to call this the Trump administration. And the winners have been growth. Like what? Like Amazon, like Google, like Facebook. So many large cap growth, technology winners, it's been a boom. Netflix and others just exploding in growth and value, which has been outstanding because they're very widely held stocks and it's pushed the stock market higher. It's terrific. Emerging markets, another huge winner. We talked about that. And then specifically, other than technology, healthcare. We're happy and proud because we initiated really nice positions in Amazon at the beginning of the year and a whole bunch of different technology names. And if you look at healthcare, that was our big position that we had. If you looked at the first market outlook that we initiated at the beginning of the year, 16.2% rate of return. Terrific. We're very happy and delighted with that. And then you kind of move over a little bit and you say, well, where haven't the returns been? And with energy and telecom, and if you watch the market outlooks, you'll have seen in the first quarter, we eliminated our energy and telecom positions both. So really what we've seen is a market that's coming together the way that we thought it would. Healthcare reform is one of the things that's going to bring us certainty. And certainty should mean that in areas of the market that are growing, like healthcare, certainty would help us explode with rates of return higher. Technology, again, we're starting to see how technology is shaping the world around us, and it's really a huge driving force and a huge impact, not just on the way that we live, but how our economy is moving forward. Let's take a look at the second quarter Trump trades and how they've performed. And there's really three main areas that we thought were going to continue to perform well that, for whatever reason, haven't. So let's go through and unpack them. The first is small caps. You see the overperformance of small versus large. We covered in the first slide, and we want to reiterate it here, small has not performed as well, which is a surprise because when Trump won in November, there was a huge surge higher in small cap companies because you figured, well, goodness, if we're going to have an America first political process here, that's got to favor companies that are just doing business in the United States, which should be small companies, which is what the market's prevailing wisdom was, which is why that area of the market surged. We haven't seen that follow through in the later part of this year. Again, it's something that we're keeping an eye on because, again, small companies tend to grow more than large. Let's dive into interest rates. Again, we thought that when Trump won that there was going to be this whole new normal, lots of economic growth, and interest rates went up to 2.5% on the 10-year Treasury, which was amazing. So there's a huge rally and excitement and optimism, and we've started to see those Treasury rates, if you can see that lime green line, it started to come down a little bit as, again, some of the Republican agenda struggled a little bit to go through. And conversely, at the same time, you had munis, municipal bonds, tax-free bonds. Those bonds have lost a significant amount of luster because you're thinking, well, geez, with Trump, this must mean we're going to have lower taxes, and lower taxes means, well, why would I have a muni if I'm not going to pay as much taxes? So you had that muni in dark green. Again, with Trump, you had those scales start to come down a little bit, and you're seeing a little bit of volatility on those sides. But what's interesting is the relationship between the two. Those municipal tax-frees and those taxable treasuries, they're both very secure, very safe investments, but the gap between those two is notable. And that gap is something that we look at as more of an opportunity for munis, more so than treasuries. So you can go ahead and keep that in mind. And the last chart is that you thought that with Trump there's going to be a real strong U.S. dollar, U.S. first, and we were going to have a very strong dollar and potentially tariffs, which don't seem like they're going to be going through given the Republicans' latest as of today. And with that, you've seen that dark blue, that U.S. dollar index, you started to slide low. It's been sliding lower certainly through the course of this year. And conversely, we're seeing emerging market investments that are not priced in U.S. dollars rise higher. So as you look at all these things, you're looking at international investments, the U.S. dollar, munis, and small cap stocks. You say, well, geez, what does this mean? It means this is the kind of stuff you want to know, you want to review, you want to understand, and say, maybe it's time to look at small cap. Maybe it's time to look at muni. And we're looking at U.S. dollar weakness, and we got to figure out, is it going to continue to be weak, or maybe is it going to be a little bit more of the same? We're going to uncover a little bit more throughout the rest of this market outlook. And of course, if you have any questions, you can certainly reach out and give us a call. So let's touch on U.S. growth. So I need to make sure we're all on the same page. We are a consumption-based economy in that we need U.S. consumers to go out and to buy and to spend money so that we can continue our economic growth, because really 2/3 of our total economic output is consumption. So jobs are important. And if you look, the rolling average for payroll trends, other than that very notable dip that we had in the recession, the Great Recession that we had a couple of years ago, we've seen consistent year over year, month over month increases. Payrolls have looked better. We've started to see later wages have looked better as well, which is terrific. So with unemployment close to 4.6%, let's call it that, on a U3 measure. And if we're looking at wages that have been improving, that's great. And you couple that with the other chart, which is people mathematically are living within their means. Again, that's the chart on the right. And essentially, if you look at earning versus spending, is that we haven't seen rampant overspending, which is terrific, because frankly, we don't want to see lots of economic growth on the backs of people overspending. But what we're seeing is economic growth with reasonable spending related to earnings, which is related to jobs. All of it comes together and says to me that economic growth has been pretty good. Hopefully it continues to get better. We want to continue to see the job market perform well. So with that, I do want to cover one quick thing about this first chart that we need to make sure we highlight is that the rate of growth with job improvement has slowed. And with the rate, if you look, it's kind of that last little squiggle, that light blue squiggle, if you look at it, that could be an area of concern because we're starting to see, again, jobs are continuing to grow a couple 100,000 a month, which is great, but we're seeing that rate of change slowly decline, something for us to pay attention to in the months ahead. Essentially, with this whole job market, what I hear a lot is people say, yeah, but we're losing jobs. We have less manufacturing jobs, the blue-collar industry, and there's just a lot of worker angst. Well, why? Why is there so much worker angst? Well, we get it. There's definitely a changing dynamic in the workforce. And ultimately, what we're looking at is about a 62% participation rate. And a 62% participation rate means that you've got 38% of people that aren't even interested in looking for a job that could. It signifies people frustrated with the workforce, not trained for the workforce. And we get to this whole thing about the milkman and then the operators, and that is, there are jobs that used to be here that were good, solid-paying jobs with pensions, good, solid-paying jobs with career opportunities, like the milkman and the phone operators that aren't here anymore. This is all part of economic growth. This is all part of technological change. In that, I think that part of the reason why we have a low participation rate is that we have a whole job to do as baby boomers are exiting the workforce and millennials are coming into the workforce to bring in new, educated people to help do a lot of the jobs of today and tomorrow. Because the jobs of today and tomorrow aren't milkmen and aren't phone operators. It's something entirely different. A lot of it has to do with technology and growth and different jobs within healthcare. There's a lot of opportunity. There's a lot of companies that are dying to hire if you've got the right skill set. So with that, let's take a look at whether or not this whole technological change is ending the world as we know it. So retail is one of the things that, as you look at across the U.S. economy, that's under attack. And it's under attack because it's changing. And it's changing because of technology. And so with that, I think there's no better way for us to summarize this than Amazon buying Whole Foods. Look at Whole Foods stock before the Amazon merger. It was struggling. It's hard to figure out consumer tastes. They have a high margin or higher margin product. And yes, there's an active and growing market of people that want to eat healthy and be healthy. We get all that. We appreciate all that. But the company really was struggling to perform financially. Amazon comes in and it changes everything. It may end up changing the way that you eat. It may change the way that you get your food. And it may take time for this to happen, but let's watch that trend because what we're likely to start seeing and what we are seeing is that there's new competitors that are popping up in this industry all the time. And we've got to understand whether or not consumers are going to want it, how they're going to want it, and how they're going to get it delivered. In my mind, of course it makes sense now that if I can get exactly the foods that I want, when I want it, without having to go to the grocery store to get it, of course, and I'll get it that way, particularly if I can get it priced like a typical Amazon service, which is to say, priced effectively, priced efficiently, priced low. So, goodness gracious, it's certainly coming. We've got to watch it. We've got to pay attention to it because retail casualties are happening all the time. Look at JCPenney. JCPenney at one point was like the bellwether signature of a solid department store where you could get the things that you needed and wanted. It was a social place. It carried the goods and services that you needed and wanted as a family and as a person. That does not describe JCPenney of today. And because you can't describe JCPenney that way, let's not get surprised that they're closing stores left and right. I could have put a picture of Sears in there too. Those are older companies that have struggled to transition to what today's economy has brought us. And we're seeing some newer companies like the Chobani yogurt folks. They make a nice Greek yogurt, in my opinion. The Chobani folks have a new retail model as an example of the way that businesses are introducing products. That's a storefront property, a picture in New York City. That's not heard of. It hasn't been seen before. So what we're looking at is new ways of doing business. Old companies that haven't been able to make a change are struggling, and we get that. It's not necessarily a bad thing for the world or for the U.S. economy or for the consumer. Let's get into a little bit more about what that means. So, because again, the question is this going to be the retail death spiral? Is this it? Is it over? Or is it just going to be Amazon? Not today and not tomorrow is it going to be just Amazon. Let's look at what the numbers are showing us. The first one in the top left shows us that retail sales rarely shrink. If you look from the early 90s all the way through today, retail sales year over year increase, sometimes a little bit more than others. Yes, of course, the Great Recession was that one very notable time where retail sales didn't increase. We get that. Recessions will have that impact on consumer spending. But other than that, retail sales year over year are increasing. We've got more people in the labor force. Again, people getting raises, spending a little bit more. This is all part and parcel of our whole U.S. economy. So, the first rule is that with the whole retail sales pie growing, let's look for continued retail sales growth. The question is where is it going to be? And if you look at the chart over, it's got that black bar graph, which shows online sales, and it's going to show the growth rates. So the first is in 2015 all the way to 2020. Look at that, $1.5 trillion of online sales in 2015, growing to over $4 trillion. Wow, that's more than a 20% rate of growth per year for online sales. That is outstanding. But look at the rate of growth. The rate of growth for online sales is slowing, albeit slowly slowing, but still slowing. So this is not an infinite thing where, again, online sales take over the world tomorrow. We do expect huge increases, trillions of dollars of increase in online sales. Some of it may be from Walmart's online sales or other brick and mortar retailers and Best Buy and others. So it doesn't necessarily have to just be web only, folks. So keep that in mind. But we're seeing that rate of pace of increase slowly come down. And the other thing, that blue line, is it shows you in that graph that the total percent of retail sales that is online will grow significantly to about 15% in the year 2020, which is outstanding. But that's not 100% of retail sales. So yes, we expect retail sales to continue to grow because that's historically what happens. Yes, we think online sales will continue to grow and maybe at some point get as high as 15% of total retail sales will be done online by the year 2020. That's awesome. Creates lots of opportunity. That's great. The bottom chart shows, again, that e-commerce, this has been going on for a long time, has grown at a 20% rate of 20% annual. That's a CAGR, that's the annual rate of growth, versus retail sales, which has only grown at 3%. We see these things. We understand that it's coming. We know that online is going to be there, but we think retail is transforming and not dying. So I don't want anyone panicking. This doesn't mean that all malls are closing. This doesn't mean that retail stores are going away and listen, 90% of retail sales are still brick and mortar and those kind of places. That's great. And the change is going to be slow. It's still trillions of dollars changing hands. We get it. It doesn't necessarily mean that all the old companies aren't going to get it. Some will. Some are getting it better than others. We'll talk a little bit more about that. But there are tipping points that you do need to pay attention to. I think the best tipping point that there is our bookselling friends. Take a look at this first chart, the blue one, which shows Borders books. You remember Borders? I do. Remember when people used to buy their books in paperback and from stores? I do. I guess that makes me a little bit old, and versus electronic book sales. There's something that is, again, referred to as the tipping point. And what math has shown us is that as soon as electronic sales of books hit 20% of the total sales volume, that was it. And you can take a look at that chart, but really that point, that 2005, 2006 area, where, again, there was a certain level of penetration for online book sales, that was it. It was over. Borders didn't grow, and in fact, it was just a few more years before they were completely out of business. That didn't mean Barnes & Noble went out of business. They didn't. But those that don't get it and those that can't adapt to that change, or the weaker players in that industry, are going to struggle. So we need to pay attention to online sales in certain industries, certain parts of retail, because again, some of the poor players will go out of business and won't be able to keep up. Some will be able to navigate, maybe hold their own, and some may excel. But again, not all stories are created equally. We just need to pay attention to that 20% figure. So, when you look at the aggregate, the 2017, we're going to see more retail companies that are closing their doors, shutting their doors, than we did in the Great Recession. Wow. And again, it's the JCPenney's, it's the Sears, amongst others, that are really struggling to figure out how to and unlock this consumer box. They're trying to figure out how to take their old model of carrying these employees and the retail and the warehousing and the inventory and discounting and make it work and make it happen, versus online sales, which is getting quicker and faster and easier than ever before. Part of the challenge in the green is what you'll see is that the retail operating margins are thin. So if you're a retailer, if you're a grocery store or general retail or specialty retailer, take a look. You're seeing 4% margins, specialties a little bit better at 6% margins, some online retailers with a little bit better 5% margin, but a 10% drop in same-store sales for many of those companies means bankruptcy. It's a very thin line of success and failure in the retail space. So I do believe it's changing. We see it changing all the time. The question is where is it changing to? Because again, in the next slide, it says, not all retail is created equal. There are some weak spots. Take a look at Macy's, Express, JCPenney, Sears, Debenhams. And if you're like, what's Debenhams? You can Google it like I did. And when you Google it, what you'll see is the first thing, when I looked at it, 70% off right on their homepage. It's a kind of Macy's-like alternative in Britain. So look at the price performance of those companies. Wow, awful, down 60, 50, 37%. Horrible names, companies that are struggling to adjust, struggling what to do with their actual retail space, their real estate space. What are they going to do? How are they going to make things work? Putting money into making their online better, more user-friendly. Oof, it is a tough road to hoe for many. But look at the bright spots. Burberry, Samsonite, Children's Place, Gap. I could have put Best Buy on there. They've certainly figured it out. And these are companies that have figured out how to discount, how to work with Amazon, how to survive in this new economy. And again, not all companies, not all retailers are created equal. So I do not view this as the death of retail by any stretch of the imagination. Again, just a repositioning. So let's look at the quote from Phil Blancato. It says, when you look at retail and consumer spending, they reignite concerns about the consumer. The U.S. economy is consumer driven whether you like it or not. Meaning, when we're finding companies and finding places to invest in, you've got to really pay attention to the U.S. consumer. Are they delivering the way that we want it to be delivered? And are they likely to do it well in the future? That's going to help indicate whether or not you got a winner on your hands. So let's look at the employment impact. The employment impact is, because we know we've got Sears, we know we've got JCPenney, we know we have some retail disruption. There's 15.8 million people that are working in the retail world right now today. And people want to complain a lot about manufacturing jobs. You say, oh, we used to manufacture and the jobs and this and all the things we used to have, but that's 12.4 million people in the U.S. today. So if you think that bringing back manufacturing is a strong part of the U.S. economy, instead we need to focus on, how about holding on to retail jobs? It's an even bigger portion of our job market. And then take a look at that red graph on the top, and what you'll see is that we've already lost a considerable amount of retail jobs. You can see that steep decline and a little bit of improvement here lately. There's a transition going on underway, folks. It's going to take some time for this to work out. And if you look at manufacturing, the hope is, well, geez, maybe some of these retail folks will be able to go ahead and go into manufacturing because we've heard that's improved. Well, the improvement in manufacturing has been really slow. It hasn't been the same. It has not matched the decrease that we've had in retail trade jobs has not matched with the increase in manufacturing jobs. So we haven't seen a full offset. The only thing that's going to really help us solve this issue is continued training and education to get us in the places and areas of the market and the economy that are growing. So where are the jobs going? Goodness gracious, look at all of those new energy, all those energy alternative companies. Look at the amount of jobs created by solar alone versus the rest of the energy industry. There are plenty of areas in the U.S. economy where the jobs are growing in great numbers. And it isn't like some of just my favorite solar companies like Depcom and some others, but there's a whole world out there of jobs in science, in a whole variety of fields of math, in different areas of computing. There's a whole world of opportunity out there. So I understand there's a change in retail. I understand manufacturing hasn't come back. But with proper training and education, getting people in the right areas of the world economy, where the world's truly headed in some of those areas I spoke of, this will continue to get better and better and better. And we'll again, as we look back at the milkman and the operator's jobs, we'll look back at some of the jobs of today and feel very much the same way. So there's a new kind of competitor that's out there. So let's look at Amazon as probably the bellwether, obvious comparison point that just dominates the news and dominates the headlines. It may not just be because Jeff Bezos took over Bill Gates' role as wealthiest man and wealthiest individual in the United States, but that's part of it. Look back from 1998 all the way through to today, and that chart in blue, you can see that's Amazon's stock price. It has gone virtually and quite literally through the roof. And when Amazon cracked $1,000 a share, it had a little bit of a moment where it dipped back. Now it's over $1,000. The sky's the limit really with Amazon. This is not a recommendation for you to buy Amazon blindly, but this is definitely my call to action for you to recognize and understand that companies like Amazon are out there and doing great things to help shape and change the way retail works. Take a look at what Amazon revenue numbers have done in red. You've seen their revenue numbers have gradually increased, of course, the positive spikes during holiday seasons. But that's a real great trend. What's different about Amazon is that they haven't shared a lot of those profits, or really any of those profits, with shareholders. They take their profits and they reinvest it in the company by doing things like, drones are one of the more popular things, but they invest a lot in their manufacturing, distribution, warehousing, all those things so that they can deliver products better, faster, more efficiently to you, and make that user experience even better. So, which is atypical. Again, great that they've focused on the consumer and made the process easier, but different because a lot of the other companies would have had shareholders that would have been impatient and said, no, don't just go ahead and plow all that money that you've had in growth and profits back into the company, share some with the shareholder. So what we've seen is shareholders continuing to reward Amazon with super high stock prices. That's great. And we haven't seen those profits come through. The big question with Amazon specifically is going to be, how long is that relationship going to last? Will it last forever? It's unlikely. So that's why I'd encourage you to look for other companies that are doing what Amazon has done in different areas of the market. So there's a lot of sectors in transition. Let's briefly cover this whole thing. So in retail, of course, there's Macy's and Best Buy. Those two things have done a lot of changing. I think arguably Best Buy has changed the best. If you've gone into Best Buy, as I have, you'll note that they just say, if we can't beat Amazon's prices, we'll just match it for you. Terrific. So now you don't need to go to Best Buy, look at a product, and buy it on Amazon. You can go ahead and buy it there. It's saved the franchise, and the stock's participated greatly because of it. And they're being disrupted. Some of these other traditional brick and mortars, and Zara and Alibaba. Again, Alibaba is something that's very, very similar to Amazon. Maybe something to take a look at. Hotels, your traditionals, your big brick and mortars, your Starwood and your Hilton, they're being disrupted by Priceline and Airbnb. Do you have any idea how much Priceline gets as a fee when you go ahead and book your hotel through them? Do you think it's like they get $5 or a transaction fee? Guess again. Priceline gets 1%. Priceline gets a percent of the whole amount that you book. So if you book, in some cases, it can be as high as 50 or 60% of your booking fee with that hotel. That's changed the whole dynamic of the traditional brick and mortar, the way that the hotels used to do business. What a fee to pay just to have someone rent my space. And Airbnb, that changes everything. It's a couple things. One, it's a new line of revenue to a whole bunch of consumers that didn't have it before. It's a way to, if you didn't know, for you to rent out your home or space when you don't need it. You can rent out a room if you have extra space. It's a great little niche marketplace that's becoming more and more common, not just in the United States, but all over the world. We got a whole bunch of companies that are changing the way business is being done. On the oil and gas side, ExxonMobil and Saudi Aramco are being disrupted by EOG Resources and Tesla. There's a great interview that I've seen here recently where Elon Musk from Tesla spoke. And he talked about the relative space that's needed in solar panels to power the entire United States. It's shockingly small area of Nevada that we would need in order to power, just for solar alone, to power the whole United States. In order to make that grid perfect and you get the solar when the sun's up and you get a battery when the sun's down, he said the battery would need to be about the size of 1 mile by 1 mile square. Wow. Take that, ExxonMobil. Take that, old energy companies, because there's a whole new way that we may be getting powered over time. It may be Tesla and it may be others. We'll go ahead and we're going to keep taking a close look at it. We recommend that you go ahead and do the same. And as you see trends change, don't be afraid to jump on it because things are moving. And TV and media, Comcast and CBS are being disrupted big time by Netflix. We already know this story. We know why. It used to be the kind of thing you had to be by your TV at a certain time, and TiVo certainly changed a portion of that, and Netflix has changed that even more. And that was, it used to be the way that you would air something would be on the TV's schedule. Now you can issue a whole season right at once. You need to subscribe to something in order to get certain programming. I got to tell you, it's really exciting. And if you look at Netflix stock, it has certainly responded very positively to all of that information, all of that news. With more user growth than they could have ever expected. It crushed analyst expectations here recently. And then you got even companies and networks like Vice that are changing the way that talent is being brought to the forefront. In that we used to have things like Friends. The cast of Friends would do $1 million an episode towards the end. That was the way the actors would make demands. And then if you look at a company like Vice with documentaries and real people showing real lives, and this is a whole different way where you're not paying for talent and you're airing what people want. Wow. And you're making all that content available online and they can watch it whenever they want. Yikes. It could be a whole new line of investing, new jobs, newly created, more profitability in different areas of the market that you didn't expect. So in the scenario of the changing or the end of retail, we've got 3 different outlooks. We've got the good, the neutral, and of course, and unfortunately, the ugly. The good is that we end up getting the tech response that we hope for, and that is technology drives the price for things lower. We're able to continue to consume more, and we continue to have more jobs created in the tech space as we've seen. And if that happens, look for consumer confidence to shoot up. Look for the market to respond positively with 11% rate of return, and unemployment to continue to be at its terrific, almost all-time historic lows, is where we are now at about 4.6%. The neutral would be that we end up having this whole tech situation ends up actually, we get cuts. And we end up seeing significant cuts in retail jobs. Those people can't be placed elsewhere. And if that happens, look for unemployment to rise from 4.6 to 4.8. Consumer confidence would still grow because not the entire market being broken, just a certain sliver of it. Consumer confidence at 6%, and then a market return of more muted around 5%. The disaster scenario would be, oh my gosh, job losses hit the US economy, and that the tech really does destroy things. And then we end up getting massive closures and things change in a way that's more dramatic and more unexpected than people even forecasted. If that happens, market drops by 1/5 or 20%, and unemployment rises to 6%. Here's the good news. The least likely scenario is the ugly scenario. The more likely is the good, somewhere between the good and the neutral. So let's look at the job market. let's look to see how people respond to the changing face of retail and how the economy continues to move. Next, we need to switch gears and talk about the Fed. Now, the Fed has a massive balance sheet. And what's massive? Well, massive is $4.5 trillion. Well, how did it get to $4.5 trillion, and what is it? Let's unpack both of those things. This chart has the blue, the gray, the red, and another, again, tiny sliver of a whole bunch of other assets in that dark brown. And we'll focus on the three big areas. The red being, the bailout assets, the mortgages being in gray, and treasuries are in blue. So what happened is that starting with the financial crisis, the Fed's balance sheet exploded. The Treasury literally gave the Fed money and said, go ahead and buy assets to stabilize pricing, because there were institutions, banks, and people that were flooding to say, get me out of these assets. I want out. I want to sell. There was no one to buy. Prices start to collapse and come down. This is what happened with the market correction. The Fed then came in and said, I'll buy it. And they bought trillions upon trillions of dollars of virtually everything. And now they have all of these assets sitting on their balance sheet, and they've gone through varying. You can see QE1, QE2, and QE3 as little subtle rises there in their chart where they were doing additional bailout programs. And now they have this big balance sheet, and the question is, well, now what? What are they going to do with all that money? And really, we thought, well, geez, shouldn't there be tons of inflation? Because if you create money, there should be lots of inflation, right? Well, we haven't seen a lot of inflation. In fact, it's been really, really low. So we're really trying to figure out is what the Fed is going to do and what that means for the rest of the whole economy. So when we talk about the Fed, their balance sheet, their biggest hiccup, hopefully won't, but may come in 2017, and that is they have said that they are going to no longer be buying any new assets. And the thought is that they're going to let bonds that they have, as they mature, just roll off. So that $4.5 trillion that they have in investments will ultimately, at some point, if they don't buy anything else, ultimately just become cash, because things will mature, things will come due, and then they'll have $4.5 trillion of cash. Wow, that's $4.5 trillion of cash? What are they going to do with it? We don't know. Well, what's the historical precedence of this kind of thing? There isn't any. So what's going to happen? The best guess is there should be significant inflationary pressures. You would think if you create lots of money and then the risk is gone that we're going to end up having pretty significant inflation. We haven't seen it yet. Maybe that happens. What the Fed hopes happens is that they won't be buying more bonds. So there'll be less buying activity, which allows interest rates to continue to rise, because they want interest rates to rise on the short side. We talked about that in the previous market outlook, in that they want short rates, which are right around 1%, to be about 3%. So they'll handle that with their Fed interest rate increases, and they want the rest of the yield curve to rise, and they think, well, geez, maybe if we stop buying bonds, then rates will be allowed to move higher. And if that happens, then we reinflate our old economy, and everything's great, and we can continue to move forward like nothing happened, or something else. And there's no way for us to be able to properly forecast it other than what we do is we stay cautious, we stay liquid, and we make sure that we have investments that we can sell in time of crisis to take advantage of opportunities that come up, and that's what you need to do. I want to go over 3 scenarios, future positives that will help fuel inflation moving forward. Because if you think about it, inflation hasn't done much of anything. It's really hovered around that 2% range. We haven't been anywhere near the 3% range or higher that at one point the Fed was looking for. We've kind of settled into this 2 or even less inflation rate on an annual basis. Inflation can be a dangerous thing. Again, inflation means it's the price for goods and services to increase on any given year. And if you have lots of really high inflation, what that means is the cost of your goods and services go up. And if it goes up too much, then it hurts your ability to buy. And if it hurts your ability to buy, and we're a consumption-based economy, that's where you have some problems. So we are always looking at inflation and how much things are going up to make sure they don't go up too much to hurt the economy and economic growth, because as we've already talked about, and we'll always talk about, we're a consumption-based economy. So with that, there are 3 areas of the market in the economy that we're going to look at really quick. The first is the U.S. labor market. The U3, the commonly published measure of unemployment, is at 4.4%. And the U6, which is that broader measure of unemployment, which also includes people who are disgruntled and who are struggling to find a job or working part-time when they should be working full-time, at 8.6%. Those two levels are nearing the all-time, never been better unemployment figures that we could hope for, which we saw in the 1990s. That's great, that's good news. But with that tight labor market means that you end up having to pay people more. When you pay people more, wages go up, which is a good thing, but it can hurt corporate profits, which is a bad thing. So we're watching very closely people getting paid more and then they can spend more, which is great. People getting paid too much and hurting corporate profits. So you've got that inflation component. The other is a tax plan. And a tax plan on the corporate side, if you go down to the 15 to 20% corporate tax rate, we would be ecstatic, excited, delighted. It'd be terrific. And if that happens, then you could expect corporate investment to go up. You expect capital inflows to go up. You could also expect stocks for many companies to go up as well if they're paying less taxes, more profits. All of those things are great. But all that business activity means is it's more spending. More spending means that prices can tend to go up more. As businesses become busier and as supplies become more constrained, the prices go up. All of that's great, as long as it doesn't go up too much, in which case we would have lots of inflation. We got to be careful of that. And the last is infrastructure. $1 trillion infrastructure construction package, should we get one from the Trump administration, we would be excited. Let's get better bridges and roads and let's start putting money back into our system. We're all for it. We're in big support of it. And again, it would mean more jobs. It would mean more demand for concrete and copper and steel and those kind of things. So you'd see copper, concrete, steel, a lot of other base commodity prices going up. All of those things that happen are all good. It just depends if all three of these things in unison, with employment, with corporate taxes, and with infrastructure all happening at the same time, can mean lots of economic activity, which should translate into potentially lots of inflation, which would kind of give us that bloated feeling right there where, goodness gracious, prices may go up too much, too fast, too soon, and hurt the economy. And we'll get emails from clients to say, is this a real issue, a concern? Here's an article I read, and feel free to send us articles that you see. We're happy to read them, happy to help describe them. So we look at the most recent history that we've had with inflation being super low as the likely norm. And yes, we see some very positive things on the economic horizon. Hopefully those things happen. But we haven't seen enough yet to indicate that we're going to have a real significant issue with inflation moving forward. We're going to change gears and we're going to talk about passive investing because trends have changed. We like low-cost index funds. We like that whole marketplace. If you look, Vanguard alone last year brought in about $250 billion of new money. We were some of that money. We believe in low-cost passive indexing. We get it. We appreciate it. We think it makes sense. It's not necessarily for everybody in every situation, but as a nice base for people to have, it's a great place to start. It's a great thing to incorporate in your portfolio. But look, it's gotten to the point where you have more ETFs, exchange-traded funds, these low-cost indexes. We have more of those than stocks, companies greater than $5 billion. More investments that are pre-constructed than the actual stocks themselves in certain part of the market. That is unbelievable. So the ETF world has exploded with options and opportunities and different things to choose from. No more so than that whole low volatility ETF. Low volatility means it's got less risk, less volatility, which people like. They're like, goodness gracious, I'd love to get the upside with less of this seasickness, and I get that. We appreciate that. And look at the amount of money that's flown into those low volatility ETFs. Unbelievable, unbelievable. And and it shouldn't surprise any of us in that last chart, if you look at the average valuation of those low volatility companies in those indexes, it's at 19.9, way above its historical average of 12.8. So these are, again, the type of things that we want you to hear, digest, and then think about. So if you have a bunch of low volatility ETFs and you have done well, you have been a lot like a whole lot of investors and financial advisors like us that have used them. Maybe it's time to take some profits and to move into something else that's gone, that has other upside, other possibility, because these low volatility ETFs have exploded in such a way that it makes sense potentially for you to look elsewhere for more growth moving forward. I want to cover emerging markets. Emerging markets are not for the faint of heart. Emerging markets are a great place to invest because you would expect areas like Brazil, Russia, India, China, to name a few, and there are many other emerging countries, you'd expect them to grow more than the United States. The United States, we've struggled to get growth more than 2% per year. We would love to get 3% rates of growth, but there are plenty of areas in the world that are growing at 6, 7, 8% on an annual basis. They're outside the United States, they're in the emerging countries, and many of them have really nice and attractive balance sheets. And by an attractive balance sheet, I mean they've got lots of cash, they don't have lots of debt, those things. It's a very stable, predictable balance sheet. In the United States, we've got a ton of debt and a ton of revenue, which is good. I'd prefer to have less debt, but that's just me. And these emerging countries have low debt, lots of growth. It's an attractive thing, so money is flowing there this year in big numbers. And I want to address it to make sure that we're all clear that, again, these emerging markets aren't the kind of thing that I want to see you flock to and flood to. I'd rather see you put money in when they're down versus when they're going up. But right now there's a whole bunch of areas within that high yield marketplace, that emerging market debt marketplace, those emerging market bonds, that may give you an opportunity to get some of that growth and that upside, because as those countries do better, their currency tends to do better, maybe versus the US dollar. Interest rates here are going to go higher, and if interest rates here go higher, that tends to mean some of the bond prices go down, so that may end up happening. And there are places in the world like Argentina, Turkey, the Ivory Coast, there's a whole bunch of them where even the short-term side, you're getting really nice rates of return. So we're seeing money flock there because the balance sheets are great, it's attractive, but don't get lulled to sleep by these kind of trends. These are the kind of investments that I believe that you make on a short-term basis. So if you're not going to watch it, put your money in and then put your money out when it makes sense, then don't even think about playing with these kinds of things because they can be dangerous. So the final slide is the matrix of how we move forward. There's really going to be 3 different scenarios as we see it. The first is growth heats up and inflation heats up. If that happens, you got to go into small cap, you got to keep your money in high yield. You can look at inflation protection for that area of the market to do well. And that would be a scenario to definitely get out of government bonds. Or we have more of a questionable market environment where growth is so-so balanced. We can't get out and we can't break out of where we are now. We can't get the policies done. We can't get the reforms done. And if that's the case, we'll be right where we are now. It means inflation should be right where we are now. And if that's the case, it's balanced. It's more of a balanced approach with different types of quality bonds and quality growth equity. Those low volatility investments would, believe it or not, continue to do well if we've got this questionable market environment. Or we could have a surprise slip. And the surprise slip would mean a drop in growth and a drop in inflation. That would end up being some kind of a surprise. And the surprises are always there and they could come. But if a surprise happens, where you go is you go into hedged equities or you go into different government bonds. Now, government bonds is for the bold and for those that really want to time things perfectly. I don't necessarily recommend flocking to them if you think the world's going to end. Just be careful there. But certainly the high yield, lots of different stock positions and inflation protected bonds, if we get an economic shift that's negative, would be something for you to get out of. So the big picture here is, given all the stuff that we talked about, the future of retail with the Fed, where the economy's been, it's quite likely that we are going to get some positive reforms. And if we do, and when we do, we'll see the economy continuing to do well, continuing hopefully to improve, and bring us to a point where we have more stuff to figure out. And that is, who's going to be the next Amazon? Who's going to dominate retail? And where are you going to make the most money over the next 15 to 20 years? And with that, that's what we have for this quarter's market outlook. Take care, have a great day, and if you see any articles you want us to read, go ahead and send them our way. Otherwise, have a great one.